In order to debunk this very frustrating myth, we first have to do a very quick explanation of how volatility ETPs like VXX actually work. What we've got here is a very normal, stable-looking term structure. Each one of these points represents a monthly VIX future going out in time. And the VXX, for example, it holds a combination of only the front 2-month VIX futures. We call those M1 and M2. At the beginning of the monthly cycle, it'll be holding 100% of M1 and 0% of M2. Then at the end of that first day, it's going to rebalance about 5% of its holdings from M1 to the M2. So at the end of day rebalancing, it's going to sell a little bit of this first one and then use that capital to buy a little bit of the second one. It does this every day until the last day of the cycle. It will have fully rebalanced to the back month, now holding 100% of M2 and 0% of M1. Then the front month M1 expires, all the futures move forward a month, and the cycle starts again. This is where that big myth comes in. Because if you listen to some of these people on social media, they say that because the VXX is selling some of this cheaper M1 future and buying the more expensive M2 future, that this is somehow realizing a capital loss in the rebalancing. I've even heard those people say that you should sell your shares before the rebalancing and buy them back afterwards. Like you can somehow avoid this chunking of the price downward. This is a ridiculous myth that really needs to die. There is no loss of capital due to the daily rebalancing. The entire thing is a net zero transaction that has no effect on the underlying volatility product. We can prove this very simply. So we're going to assume the same thing, end of day rebalancing, and currently the M1 future has 80%, and the M2 future has 20%. Remember, at the end of the day, it does have to transfer about 5% of the capital from M1 to M2. So same thing, we're going to sell 5% of this one, and we're going to buy 5% of that one. So did that change the price of the VXX itself? No, of course not. All that happens is you're moving money from here to here. The number of shares will change of each one of those futures, but the actual value is exactly the same. Value just goes from one pile labeled M1 into another pile labeled M2. It's a net zero transaction. The price of the VXX is the same before and after the rebalancing.